This episode is proudly sponsored by ShakePay, Canada's easiest way to buy and earn Bitcoin in 10 minutes or less with no deposit or withdrawal fees. It's so easy, even the boomer can do it. Guys, I've personally been using ShakePay for several years and highly recommend them. Their mobile app makes it super easy to buy and sell Bitcoin. All you have to do is e-transfer directly to your ShakePay account and you're ready to go. So head over to shakepay.com or download the mobile app, use the referral code Loonie Hour and get $30 of free Bitcoin when you sign up. ShakePay gives out free Bitcoin to every user every day just by shaking your phone. They call this the shaking sats feature. It's awesome. I highly encourage you to go check it out. ShakePay has also just launched one of Canada's only Bitcoin cashback prepaid credit cards, which gives users up to 2% Bitcoin cash back on every transaction. If you want to opt out of Canadian dollars and start earning rewards through Bitcoin, go check out ShakePay. Once again, guys, that's shakepay.com. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to Loonie Hour, episode 57. As always, joined by the three amigos. We got Keith Dicker of IceCap Asset Management and Rich Diaz of Acorn Macro Consulting. Welcome back to the show, gentlemen. What's shaking?
My screen, apparently. You guys give me grief because my computer keeps moving around. I'll try to do better today.
Rich has been in the UK, still hasn't furnished his apartment 3 months later.
3 months later, I still haven't furnished my apartment. Nothing's going on. Corruption in Canada. I was reading Sam Cooper's amazing article about that. Obviously, the market's crazy today. I think 5% on the QQQ, which is the tech sector index. Inflation data, lots of good stuff. Inflation data, COP27. No one cares about China anymore, even though they produce more of the greenhouse gases than I think most of the developed world. Lots of good stuff, Keith. Tell me what's going on.
Slow news week.
Yeah, slow news week.
I'm just sort of saying with you guys, like there's nothing like any cool, personal stories happening or anything. But it's since last week, there's been so many. Like every day it's been a bit of a whipsaw with economic data coming out, narratives. The Americans voted again, and we get jobs numbers coming out both in America and Canada and stuff. So I think it's just been another just exceptional week market-wise. And we always keep talking about, we keep looking at, is there a reason to change our narrative? And right now, everyone is, all watching the Fed. So, today with Thursday, getting the CPI number out, is a pretty strong reaction to it. But we'll talk about that now as we get going. But today has probably been one of the most unbelievable intraday moves I've seen in markets in a long time. So a lot of these currencies have swung about 3%.
It's wild.
Just from the low to high. Week. Unbelievable day.
Yeah, I've been glued to Twitter all week. It's been a wild ride. But we'll open things up here. We'll sort of pain you. We have to get through the Canadian stuff before we get into sort of the bigger, more interesting macro stuff. But we had briefly touched on. We missed it last week, but we had the Canadian economic update from Krista Freeland, the finance minister there. So a couple small announcements, I suppose. So Canada is to impose a 2% tax on stock buybacks as of January 2024. If you're looking for more sort of debt jubilee type of narrative, the Canadian government is going to make all student loans interest-free. This includes loans that are currently being repaid by Canadians. The move will cost the government $2.7 billion over 5 years, and then $556 million annually after that 5 period. So interest-free loans if you are going to school and taking on student debt. So there you go.
I think it's interesting, though, because student debt isn't anywhere near as big a problem as it is in the US. So once again, our dear leaders basically just following whatever the wind is blowing down south. I guess the hurricane just comes and absorbs the political the political sentiment up here, which is a bit, I mean, I'm not saying that people didn't have student loans. I did. My sister did. I know people still paying them off. I get it, but it's not at all the same problem as it is in the United States. And so it just it makes me laugh. Anything that goes, I feel like they just watch like CNN and Fox News in the cabinet meetings and go, that's what we should be doing legislating on this week.
Certainly not.
I don't know. I just sold. I emptied my crypto wallet 3 days ago to pay off my student debt, so I did that.
He's still paying it off 50 years later.
Yeah, actually, when I went to university, my tuition for a semester. Take a guess how much it was.
Oh boy, here we go.
Here we go. One guess each.
$100 for the year.
Well, it was $482.
Wow, that's amazing. We're pretty close.
Yeah, not bad.
I was actually joking. I can't believe
showing
your age.
Yeah, thanks. However, with the you made a good comment, Rich, that it's the economic cost of doing that, maybe not that much. I think a lot of people do appreciate it. That they really will. And so, hey, that's if you're going to spend money as a government, maybe that's not a bad thing to spend it on. But
I agree
it goes,
with you.
Yeah. So we go back to the other big challenge that the government is going to have. It's that it would be very cool if they could somehow get someone else pay for the interest on the federal debt and provincial debt. And I'm sure they're going to socialize that, of course. So all the students out there that are getting the interest waived on their student loans. I got bad news for you. Indirectly, you're going to be paying interest on the federal and provincial debt, for the next 50 years as well. But anyway, I think that's not. I think I would do that. If I was running the country, I would do that as well.
There's no such thing as a free lunch, is what you're saying.
Oh, you stole my pickup line.
Yeah,
that was.
Oh man, it always comes back. And then sort of last little news on that, we'll wrap that crap up. But they've got 2023. They just released some of their housing stuff as well. Basically saying that the foreign buyer ban for January 2023 is in fact going to be implemented. Still actually waiting for some small minor details on sort of the implications of that, but basically any foreign purchaser that has engaged into a contract prior to 2023 will be grandfathered in, but there will be that 2-year ban on foreign purchases. People have asked me what my thoughts are on that. If you look at the BC government, so BC, I would argue, probably has more foreign capital coming into it than the other provinces in Canada. If you look at the provincial property transfer tax data, where they record people's basically identities or their nationalities, etc. Foreign buyers, as they are defined in Canada and the BC, accounted for 1% of all transactions in British Columbia, basically over the last couple of years. So you're really essentially, I guess you can say, well, maybe we're removing 1% of demand, because the reality is most of these people are permanent residents or students or on some sort of visa here. So I don't really think it's going to have any impact on the market. But it's funny because the timing, this ban is coming in at the time when nationally we're going through the steepest housing market correction we've seen in 2 decades.
You mean that they're not proactive in their legislation? Is that? I'm shocked, I tell you.
It took them like 8 years to figure it out.
You glossed over a really interesting thing, and I think, well, I have a question about it anyways. Who knows? Keith will let me know if it's interesting or not. But if you have a visa or PR, then you're technically not a foreigner. So you could send your kid to school here, as you might do in the western part of our country, and then give them a briefcase full of cash. They buy whatever they want, and they're not a foreign purchaser. I'm being a little cheeky, but isn't that basically what can happen? Or a PR after 1 year?
If you're here like working, there's all these like little technicalities. If you're here working, if you're on like a student visa, PR, that's what I'm saying. It's just like as a foreign buyer, like there's like hardly any people actually get sort of captured by that. What's interesting, we actually chatted about it last week because we said, the Canadian government is going to ramp up immigration targets to 500,000 people. We got some great feedback from our audience, people that are in the immigration space. So thank you for that. So yes, if you're a provincial nominee, you have to stay in the province that you're sort of being groomed in. But once you do get your PR status, you can then leave and go wherever the hell you want. So long story short is you can pretty much pick up. And so basically they were saying is like, yeah, you might get a provincial nominee in Saskatchewan. And then of course, as soon as you get your PR, you're like, well, I'm getting the hell out of here. And you end up in BC or you end up in Ontario. Is the
you know what happens next? You know what happens next? Then you're wishing you were back in Saskatchewan, right?
I've never been to
so it's
Saskatchewan.
crazy though. So they're ramping up. I didn't realize this is they're ramping up the targets to 500,000 people in the next couple of years. But in that 500,000, what's not included is what they call, I think it's called non-permanent residents, which is basically it's like foreign students. So foreign students aren't captured in that 500,000, for example. And I think we had something like a couple 100,000 foreign students enter the country in the last 12 months. So it's like you're really actually adding not 500,000 people, you're potentially adding like 700,000 people.
But the thing about foreign students is they go like I don't know what it was at your university. I know at McGill they pay like 5x the tuition fees, and they subsidize all of the Quebec residents and the Canadian residents. So I'm all for that. Bring them down.
No, but
let
I think
them pay for the university.
The point being though is that those extra 200,000 people. So let's say,
still a lot.
Now bringing 700,000 people. 700,000 people need a roof over their head, and that is demand into the rental market predominantly.
Yep.
So, and the fact that we're not actually capturing these people coming into the country under some sort of statistic to figure out the housing supply that you need is kind of, I think, why we are where we are. But
I think what Steve is trying to say is that they need a realtor, right?
I'm pumping my bags right now. Anyway.
Oh wait, speaking of shameless plugs, I want to plug my one of my very, very dear friends who's a singer-songwriter out of Montreal. His name's Ryan Stotland. RyanStotland.com. Go check him out. He has a new website. He has a show at the end of the month. He's a lovely guy. Anyway, there you go. That was my shameless plug for the week.
Is he our next sponsor?
We have let's see how his show goes. If his show really blows up and he becomes he becomes the next Taylor Swift, then yes, he'll definitely sponsor us. But anyways, sorry, I forgot to do that last week, and I needed to recover.
Well, there we go. You're welcome.
What's next? Plug. What's next? Yeah, free plug. What's next, Steve?
Yeah, just lastly on the Canadian housing front, like I said, we'll get more into the interesting stuff here. But if you guys have been following the, I always get it wrong, Romspen. They're one of the largest private mortgage investment corps in Canada. So they are basically what they do is, right, if you can't get a traditional loan at a tier 1 bank or an alternative lender like Home Capital Group, you go to one of these private lenders. And so they've actually, I think it was 2 or 3 weeks ago, they said, listen, we're going to basically slowly start. We're basically curtailing redemptions. There's just not enough capital coming up for sort of redemption that we can pay out these investors. So we're kind of slowing withdrawals. They've now officially gated the fund. So if you had money in with Romspen, which is, again, one of the larger mortgage investment corps in Canada, they have officially gated funds. Basically, there's just not enough loans turning over in the private lending space in Canada. So this is kind of like a sentiment indicator, I think, moving forward, because the reality is we're going to see a lot more of these mortgage investment corps in Canada starting to gate investor funds, I think, coming in the new year as the housing market ultimately continues to weaken or is in a very soft situation. So that's big news, because I think, like, if you're looking for sort of knock-on impacts, it's basically just a tightening of liquidity, right? So these guys are actually basically they're not able to issue new loans, so that the credit spigots are getting tighter and tighter. So I'll kind of explain maybe quickly how that works. But so, for example, most of these people, let's say, you can't get approved at a bank, but you really want to buy a house, you're trying to figure your income situation, maybe you're self-employed, you don't have a great T4 situation. So you go to Romspen, for example, and you get a, first mortgage on your home, you put 25% down, they issue the other 75. These are always typically 1-year terms. And every 1 year, the Romspen will make a decision to renew you, or they'll ask you for their money back. But because there's no liquidity in the housing market, prices are down, interest rates are up. These people don't they're not able to refinance and go to traditional lenders, which is typically the game plan, right? Like nobody goes to a private lender with the idea that they're going to be there for the next 10 years. It's always a stopgap. It's like, okay, I need to clean up my own balance sheet. My T4 is going to be higher next year. Once I get that sorted, I can pay out Romspen and move to RBC. Now what's happening is, again, because prices are down, rates are up, people are not able to renew, refinance. And we're seeing a lot of situations where the lender's saying, hey, I want my money back. And the guys will like, come and get it. I'm not selling. I don't have the money to pay you out. You want to go through the foreclosure process? Good luck. Because the reality is the market's soft, prices are falling. It's a long process in Canada to go through court-ordered sales. And so there are a lot of them are just having to auto-renew these people. But if you as an investor, you want your money out, how do you get it out if they're not having loans turning over? So this is the situation that these MICs are going to face in the next 6 to 12 months.
So what I find interesting with this, because I know we brought up this story a few weeks back, I think. We've been talking for a while that the Canadian economy should be entering a recession soon, but it seems soon keeps getting pushed out a little bit because the data, like Rich will tell you as well, the Canadian data is still pretty good. But you always want to look for these anecdotal stories. What's happening here, and what I suggest is anyone that if they think that the Romspen story, it's a one-off story, it's nothing to be worried about. I think you're dead wrong on that. And so the other thing to think about, in the investment world, if so these funds, I think they're probably yielding 6-7%. I'm assuming before rates started going up.
About 6 to 7% is usually what they're targeting.
So we in our world, we have things we call the risk-free rate of return. So you go back to academia. So when I was paying $400 tuition for one whole semester, we learned these things back then. But back then, if the risk-free rate of return was say 4%, which is the Bank of Canada rate, whatever you want to earn above 4%, you're taking on risk to do that. So if a fund is paying you 8%, you're saying, hey, I'm getting twice the risk-free rate of return. So that's not guaranteed. There is a risk here with it. So when rates were back at 0% or a quarter point, whatever you want to call it, and then a lot of these funds are promising they're going to pay out, 5, 6, 7% or whatever it is. That's when, as a manager, we look at this, side-eyed and say, hey, there's something not quite right here because something can tip over. But for everyone, if you're always learning from the markets, if you're ever invested in something and all of a sudden you realize that liquidity is getting tighter, that it might be more difficult to get your money out, get it out immediately. Because what's inevitable is that, as Steve mentioned, they're going to gate this thing, which means they close the gate and you can't get out. And once you gate something, the next step is that when you are able to get out, you're not getting par value of what you think you're going to get. So that's a little story. So again, with people managing money, liquidity is always important. We're looking for is extremely important. Now we jump over to the Canadian economic side of this. And, is this the tip of the iceberg? Is it something else is coming up next? But again, we suggest that we are going to see some slowing data coming up. What do you think there, Steve?
Oh, I was just going to say Keith's responsible for starting a run on the Canadian mortgage investment corp space. Everybody get your funds out.
Well, let me contribute to that because I think we should run over some Canadian data that's deteriorated over the last little while. And,
Please.
This is a Canadian podcast. It's only take a minute, but there's something called the Canadian Composite Leading Indicator. So the OECD, the Organization for Economic Countries, something I always screw up the acronym, but anyways, the OECD is not only a group of countries, but it's also a research kind of non-profit research institute. They have lots of good data, and their leading indicator is at a 2 or 3 year low. There's the CFIB, this one I remember, which is the Canadian Federation of Independent Businesses. Their barometer is at a 2 year low and falling. You've got the market manufacturing PMA. Market spelled with an I is a PMI. Another company that does survey on manufacturing and services companies. And again, that's it's now, I think, below. Yep, it's below 50. Remember, 50 is the expansion contraction line. So that's the manufacturing. Then there's the
Rich,
Ivy School of
tell
Economics.
us.
Anyways,
That's the diffusion index. The diffusion
No,
index.
It is the diffusion index. I was trying not to use that word for fear of reprisal, and I got reprisal.
It's a
anyway.
bingo, isn't it, Steve? Bingo
is a
on
bingo.
diffusion index.
It's gonna be added to the card.
And then there's the Ivy School, which is I think in BC, right? The Ivy School of Business School. Where is it? In Ontario.
Is that Western?
Western. Okay, sorry. So the Ivy also, that school also, one of the professors there, and I think it's a school of research or whatever. Anyways, they also produce their PMI, and that is absolutely cratered. And interestingly, the employment number for that series has also come down, but it remains in expansionary territory. So anyways, it's starting to pile up for Canada. And it'll be really interesting. I mean, net exports are still a drag. We've talked about investments. Remember, a couple of weeks ago, we talked about gross fixed capital formation and how part of it is non-residential. And then we talked about residential. The residential bit is rolling over like crazy. Anyways, it's not the best. It's not the best.
Man, I keep getting all these anecdotal stories, like just talking to people in, day to day friends that, hey, my friend, they're in this situation, and it's really fascinating just to see all these. I really think like normal people, just day to day, 9 to 5, good, hardworking people that are like suddenly caught offside with like mortgage rates going from, like I said, 2 to 6%. Mm-hmm. Funny story, actually. So I have one variable mortgage with Scotia on an investment property in Alberta. So I was just curious, right? I was like, you know what? Let's like, maybe I should just lock this in for 2 years. Let's just, out of curiosity, I floated it. But I only floated it like 3 or 4 months ago. So it's, I kind of knew what I was getting into. So I called them and I was like, hey, just kind of curious if I can take this mortgage and roll it into like a 2-year fix instead. And she's like, yeah, okay, sure. Let me look into it. Gets back to me and she goes, yeah, I can lock you in for 2 years at 6.15%. I'm like, oh man. I was like, is that your best rate? And she said, and there was like a payment. There was a payment as well, because I was going from a 5-year variable to a 2-year fixed. So because you're shortening like the duration of the term, is that they penalize you for that. And she was like, yeah, it's like a $6,000 fee as well. And I was like, man, and I was like, 6.15. I was like, can you guys do any better? Can you waive the fees? And she's like, no, like I just tried. I had someone ask yesterday, homeowner, he did the same thing as you. He took the 6.15 and he paid a $9,000 penalty. And I'm like, man, like that's the best going rate for
Yikes.
2 years. Once you're at like this particular lender is like sick. Like, I just don't think these housing markets are going to work very well with rates at 6%.
Yeah, that's why I guess consumer confidence is making new lows. I forgot to add that one in there.
But that's going to start to show up, right? I just think like,
yeah, it is.
There's no way that, like, I'm just hearing all these people that are like, yeah, they've got a kid on the way. They had a pre-sale that they bought like, a year and a half ago, and now it's coming to complete, and she's going through mat leave, and all of a sudden they just locked in their mortgage rate because the thing's finally coming for completion, and like they locked in at like 5.9%, and like their payments are like exorbitantly high relative to their income because you know what I mean? It's really fascinating. So I think we're going to see continued slowdown, which we'll get into here.
So what's interesting with all this? So we're getting anecdotal stories about things are, they're getting tighter, but yet national data points are not entirely suggesting that, especially the jobs data, which Rich will dive into there in a minute. But something will, break here at some points. The anecdotal stories will get reflected in the national data points that's coming up. That's
I think
my
it already
main
is.
point.
Yeah, I think it already is. You could argue it already is with the PMIs and some of the business confidence stuff and consumer confidence. I think it already is actually.
So Rich, I have a question for you. You're looking at the Canadian data, and Canadian data is, let's take it with a grain of salt, but do you look at that today and go, this all looks quite weak? Or are you feeling, no, it's not that bad? Or what's your like quick take on that?
I think if it was taken in isolation, I'd say, maybe we've already had the recession, but I think because that's the case, I'm not going to get into it, but you could make that case for the US, saying there's been already quite a bit of negativity there. And maybe you've had, who knows. But I think the problem you have is, I look at Euro area PMIs, they're all the major countries. So France, Italy, Germany, Spain, and then, the rest. Those 4 countries make up like 75% of the GDP in your area. So that's what really matters. But anyway, those PMIs have rolled over. You've got, the Centix economic indicator, DG ECFIN, which is Department General of Economic Finance. Like every indicator is down. Consumer confidence across the world is down. Except for India, for some reason, India's consumer confidence keeps rising. But my point is, because you have all these sort of corroborating evidence, you have real interest rates that are tighter. You have mortgage rates in the US you have credit spreads that are wide. And I mean, it's one thing after another thing after another thing, to the point where I really can't off the top of my head think of something that's unambiguously positive. And so that's a real issue. And so because that's true, Canada's in a situation where, you're going to have, it's very, very tough to fight against that current. Let's just say you have domestic negative current, which is partly to do with housing and real higher rates. And then you have a global current that's also going. And so it's tough, man. I know one piece of data that's unambiguously positive: immigration.
No, I've got another one for you. Jobs numbers 10 times higher than expectations.
Yeah, so it came in at 108,000 for the month, which was 10 times bigger than expectations, which is significant. I mean, I can't swear to this.
Let's say it's statistically impossible. But go ahead.
I mean, okay, Keith said it, but so the total number of people employed, for people who like to know these things, in Canada is 19.7 million. We have a participation rate that's relatively high. I think it's higher than it's in the 60s or so, or in the 70s. I can't remember now. Anyway, no, 64 and a half, whatever it is. And I think that employment rate is directly related to the fact that we just had one of the banner years in immigration in the last 50 years or so. The problem, we've discussed this before, it's not about that kind of artificially prop up your country's economy, and nominal GDP is a hell of a drug, man. You have enough people coming into your country and you can paper over a lot of bad stuff. The problem is, you can only do that so long before A, the reality kind of bites, B, you get political stress, C, you get stress on existing infrastructure. There's other stuff, of course. But I think in general, I think that's it's like I said, it's very, very useful. You let a lot of people into your country and you can paper over all kinds of shit data, which is mortgage lending is starting to go down. Retail sales per capita is going down. Inventories are up, which is bad, right? I mean, that means companies have to absorb some losses on that. House prices are going down. Anyway, so it'll be interesting to see over the next 6 months. Obviously, we'll keep people posted. Stay tuned to the Loonie Hour, the best podcast online, of course. But it'll be interesting to see if immigrants or people who are prospective immigrants to Canada, they might be invited, they might be allowed in, but they might choose not to, right? Given what's going on globally, they might worry about finding a job in Canada. They might worry about funding their trip here or there. I mean, you know what I mean? So it'll be interesting to see how that plays out.
Yeah.
Okay. Let's come back to reality for a second. Let's do that. So there was.
Did I say that was controversial? I didn't say anything that was controversial.
It's not controversial. So remember, everything fits together here. So just a few weeks ago, we had the Bank of Canada. They came out and they raised rates by 50 basis points, which equaled a real nice lemon loaf from Starbucks.
People are upset about that, by the way. You still owe us a Twinkie, and we're going to hold you to that. Continue. Yeah.
If that's what gets people upset, we're nowhere near a recession or a bad time yet. That's not a bad thing. That's not a bad thing.
Like, what's next? Remember, are you going to pull a slice of apple pie in the next one?
Well, I actually made some date squares a couple of days ago. I love date squares. If you know what they are, you know what they are. However, so again, the Bank of Canada, and I said they did a soft pivot because they were 100% priced into 75 basis points hike, and they only did 50, and it had nothing to do with the Loonie Hour, Twinkie bet. That's not why they did 50. Now that we're seeing some soft data coming out, like for the Romspen funds, for example, some of the bank data and on loans is, again, there's a lot of stories. Something spooked them in the market. As well, I want to comment. Remember last week we comment on the Bank of Canada QE for overnight operations, and I said it's a bit funny. I have some more filler news on that as well. But the Bank of Canada, they did this for a reason, because they know that, okay, if they continue to hike aggressively, it increases the probability of a hard landing, and they don't want a hard landing, right? Because a lot of people barking at them right now from Ottawa for this. So they went a bit light, and now all of a sudden we get this jobs number coming in out of the blue. And I don't know when the Bank of Canada, when they get the number, they'll tell you they get the same time as everyone else, but I'm not a believer in that story. But for it to come out so strong, it suggests to them, or what the market would say, wow, you have to start hiking more aggressively now. So it creates even more uncertainty on what the Bank of Canada is going to do. And, for whatever reason, why it came out to be 108,000, I think is sort of irrelevant. The point is, like the sharpest guys in the country that followed this very closely, collectively, they thought it'd be like a 10,000 number. That's it. To come out 10 times, I suggest what's going to happen. This number will get either revised away, or we'll have a very sharp negative number coming out. I've seen that in the past with this jobs number. Just say, I remember a few years ago, it was like plus 200 and something thousand. And then for the next 2 months, it was like minus 125 each, which exactly canceled out the big surprise number. But this number is going to get adjusted. To put things into perspective, how much larger is the American population relative to the Canadian?
10x.
Let's say 10x, basically.
10x,
there's
right.
There's 140 odd million people who work in the 150 million people work in the US.
Yeah. Okay. So, and you said the Canadian number is like 19 million, I think you said, Rich, for workers?
Yes. Yeah.
Yeah.
I mean, it depends how you calculate the workers, but basically there's 153 million people who are on the non-farm payrolls in the US. So
the American equivalent number was 193,000 for the month.
Last month? No, it's 261, I thought. But anyway, it doesn't matter.
It was 193. And but the point is that now we have the Canadian economy, which is 10 times smaller than the American one, produced half as many jobs. And again, this is where I say the American data points are actually really good. So that's why there's a lot of attention paid to them. And for the Canadian ones, not as much. So when we get a big reaction from it, you have to realize, okay, that this is shuffled around a lot of the chairs on deck, and something will change with this. But I promise you, the Bank of Canada, looking at that number, they're thinking, oh boy, now we're getting pushed back into a tough spot.
So what you're saying is that we're setting the most important price metric, the price of money, on some very questionable data. The StatsCan random number generator.
No, I don't think that. I just think that where the media and markets are placing more emphasis on the jobs data than what the Bank of Canada would be.
Good to know.
Do you see what I mean? Like the other way around. Yeah, that's what I think with it.
So we got a lot to get through. So I'm gonna have to switch gears here and get out of Canada land. But one of the things that Bank of Canada's obviously been talking about the last meeting was financial stability concerns. And, we've certainly been talking a lot about the podcast here of all these, financial stability concerns as well, and things that are happening in markets. And there's just been a barrage of events happening this week. We've had a bunch of listeners obviously messaging us. We appreciate that. But you can't go unnoticed is FTX exchange, so the cryptocurrency exchange, not ShakePay, God bless them. FTX, the second largest cryptocurrency exchange, is basically insolvent. So they seeked out a bailout. I mean, I can walk you through the whole picture, but basically, so my understanding is I haven't been following this too closely. So Binance is number one. They're the largest cryptocurrency exchange. I've actually used them as well. FTX is your second largest crypto exchange. And so Binance and FTX, I guess they were kind of buddies. Binance figured out that something's wrong with FTX. They basically pulled a bunch of their funds. It sent FTX's sort of stable coin, I believe, crumbling. And so I guess the rumor is that FTX also has a hedge fund called Alameda. Rich, correct me if I'm wrong.
I think that's right.
So there's the belief that basically they've been siphoning funds from FTX over to Alameda to basically paper over. I think apparently they blew up during the Three Arrows Capital debacle many, many months ago. It's kind of like that old story, right? Like there's never just one cockroach. Like there's never just like this isolated event. And so they believe that this is all stemmed from significant losses at FTX's sort of hedge fund. And so they've basically been using client deposits, I think, to offset those losses over there. And I guess Binance was one of the early people to sort of figure that out and basically sort of pulling their funds out of FTX or whatever. Anyways, that's a long-winded answer. I'm sure people will chime in and correct me that I've made some mistakes there, but that's kind of what's going on. And so now you basically have everyone was calling Sam Bankman-Fried the next Warren Buffett 4 months ago, because he was coming in. So he was responsible for bailing out some of the other larger cryptocurrencies. He was trying to help out Celsius, which went under. He helped out BlockFi, which is a massive, massive company. So he was kind of like, people were calling him like the JP Morgan of like crypto, where he would come in, like bail out sort of all the people that need the bailouts, and he would sort of accumulate all these big, great companies. And now, of course, he's the one that's going under, 4 months later. So Rich, I don't know if you have any comments, but it's an incredible story. And now we're going to see really where the contagion is, and all the bodies are floating up.
I just think it's just, I don't have much to add to the FTX thing. I only think of Bitcoin in its with respect to its liquidity issues, which is, I think, part of what's going on. And I think that's what we're seeing when you have, when the tide goes out, you can see who's wearing shorts and who's not, and who's naked. I think that's like a Warren Buffett quote. And I think it's meaningful to me in that I think we're going to see probably more of that. Whether it's we saw the UK pension fund stuff, we saw this. I think it's just, like you said, there's more than one cockroach.
Keith?
Yeah. Again, like we're pretty agnostic towards these markets. If for whatever it's worth, we have not bought any of the cryptos, in our business or personally, I've not touched them. But again, this is the view from us as managing money. We've been interested in this for a while, so we're always watching any kind of a market for an opportunity. But from a very plain, simple perspective, I know it's a very complicated world, and people can roll their eyes, if I talk about it, because I don't know anything about it. However, what I do know is, for this market to heal itself, it has to attract new money into it. So you need to convince, investors like me that, hey, it's safe to come in here. And at one point, we have a target I had now for a while, and we're getting closer there. But when I see events like this happen, it just forces me to pause and say, like investing is hard enough as it is. You want something to move based on the way it should. But when I see all these other shenanigans happening underneath, it gives me very low confidence that that's a market I want to participate in. So what's positive, though, that it is getting cleaned up and cleaned out, and some folks are losing their money. But, this is a pretty big black eye on that market for people like me who haven't touched it. Does that make sense, Steve?
Yeah, I think
it's a really good point.
I think it's a brilliant point, because I think, like, someone I've been in the crypto space, like small. I mean, again, I'm not an expert in crypto, but I understand enough to maybe be dangerous, I suppose. But I think that what we've seen over the last 12 months is just, I think, really discouraging. I think it's going to weaken adoption and really impair trust. It's going to be hard to recover from this. I think it's going to recover. I think you're going to see more regulations. What we're seeing is a lot of these entities that are actually blowing up are not really like US regulated. They're actually like set up in the Bermudas and whatnot. That I just think it's interesting, right? Like we had Celsius blow up. Now you've got FTX blowing up, but people in the crypto space are saying that this FTX event is the largest crypto event. It's larger than Mt. Gox, which was the last exchange. I believe Mt. Gox was actually a Canadian exchange that blew up like 6-7 years ago. So they're saying that this is actually a larger event, but I think anyways, FTX has something like an $8 billion shortfall here. So I think a lot of depositors are going to be on the hook. Speaking of money on the hook, we on this FTX event, it was actually the Ontario's teachers pension plan that was an investor in FTX. I think they had deployed $200 million. Again, $200 million. Keith, I'm sure you can comment on this. Is very small potatoes for the Ontario teachers pension plan, but I mean it's probably being written down to zero, and I don't think I wouldn't say it's insignificant. I mean, it's still money that's gone up in flames.
I mean, it's again, just being sort of pragmatic about it. It's tough for them because it's one of the hottest new markets, all this innovation and deep thinking. And you get groupthink taking place. I mean, they have to participate in it because if they don't, they're losers. That's what happens. And whenever you invest money, everything isn't a winner. That's why you have a very good strategy. You're diversified, risk control, and everything. So maybe the amount they allocated, it's just it's minimal. It's not a big amount. It sounds a lot to us, of course, but that I don't know how big the teachers plan is. It may be Rich can check it out real quick. But again, it happens. The optics are not good at all, so they have to deal with that. But
okay, so
I can tell you it's worth 220 billion CAD, but I'm sure they had a lot invested in bonds, so it's definitely lower than that now.
I got it 240. Canada's third largest pension fund, the OTPP, oversees 242 billion invested in FTX trading in 2021 as part of a $420 million funding round. So small potatoes, I guess, in the grand scheme of things. But to Rich's point, right, when you got $240 billion and you're mandated to be in a certain amount of bonds that are getting eviscerated as well, it's probably been a tough year for a lot of these pensions.
Maybe they could have bought student debt, for example. But again, it's not fair. Again, like when we're managed, like we lose money as well. Like when we're investing, things go up and down and everything. But the way that world works, they're always looking for the next big thing. And I think what we're learning that a lot of pretty smart firms out there and investors were in this, that they're taking some losses, and a lot of small investors as well. So like it's not a fun day for anyone. So let's just be clear, I guess.
There's one more thing I wanted to add with this FTX thing. I think for me, it sort of draws a red flag because I think regulators and people like Rishi Sunak, who is the Prime Minister of the UK, who loves central bank digital currencies, may go use this as some kind of excuse to say, see, this can only work if it's under the control of the government. And I know maybe that's a bit tinfoil hat for a Thursday afternoon, but that's for me, that was like one of the kind of things that I worry about, which is they'll sort of use this. The whole point is that it's deregulated, that it's what is it called? DeFi,
Centralized finance.
Decentralized finance. And the fact that I could just totally see a politician using this as an opportunity to say, we need to centralize this.
Well, the CEO of Coinbase actually made a good argument on Twitter. Again, obviously he's probably pumping his own bags, but he was like, listen, like all these big blowups you're seeing of these exchanges are offshore exchanges. because the regulations sort of domestically in the US, there's no crystal clear sort of regulations. It's very murky. It's hard to understand. So all these companies are setting up these operations sort of offshore where there is like, it's the wild west, and people are going and depositing their money there. So he's arguing, that we need to sort of have some more sane, policies in North America, so we can have properly regulated crypto institutions and safeguard people's money. So, like I said, most of these blowups you're seeing are not U.S. regulated crypto exchanges. So anyways, take that for what you will. But I think the other big news here we got to jump over to is everybody's favorite CPI inflation data.
Yes.
Yeah, Rich, maybe I'll let you take that one away. But the markets, I'm not sure what they were pricing in or what the expectations were, but CPI inflation on a year-over-year basis for the month of October coming in at 7.7%. Markets obviously loving that because they're up big time today. So, Rich, maybe if you want to unpack that a bit further.
Yeah, sure. I mean, the markets are up because of this, it's this hope, it's this hopium that we've been talking about for the last few months, which is that, if inflation's weaker, then the Fed will slow its rate hikes or stop its rate hikes or pivot or, God forbid, even cut. And so that's why the markets are up. I think the tech is up 5%. I mean, it's just absolutely 6% now. NASDAQ composite, which is quite an absolutely incredible number. And bonds are also up. So just remember, so bond yields go down, I mean bonds price go up. So the bond price is up, meaning the yield is down. But anyway, just to quickly go over the numbers. I mean, the headline was 7.7. Interestingly for me, services, which is something we've talked about being very sticky, came down to 7.2. Something we've always talked about a lot, which was the other core components. They also, it depends on what you're looking at, but like core X shelter, which is 5.9. So that's now you've really peaked. That trend is quite clear. Other things that I looked at is, again, the shelter component. And there we have some bad news for all the people who think that, that inflation is going to roll over and head back down to 2%. Like I've seen some models floating around on the internet. Shelter component rose again to 6.9%. And remember, we keep repeating this, but shelter is 41.6% of the core basket. And so that's why, to me, I know it's not investment advice, but I'd definitely be fading this tech rally. I still, although I believe that we've peaked in inflation, I think the idea that we're going to snap right back down to 2%. And all those idiots who said it was going to be transitory will be, sending me emails saying, I told you so. I don't buy it. Core inflation is still 6.3%. And the other thing, and the final point I'll say, and then I'll happily hand it over, is for me, we talk about different ways of measuring inflation. And one of them is the median CPI. And again, it's that breadth. It's sort of a breadth measure of your inflation. So it's another measure of sort of central tendency. What is like the overall trend? And although it did stop rising like precipitously, it's still 7%. And I think that that's like a meaningful number, and it tells you sort of the underlying speed. I mean, there's obviously things like used cars and et cetera, that have really cratered. But yeah, that breadth measure to me is that Cleveland Fed CPI, and we'll share it in the video. That's the one I'm really keeping an eye on.
Keith, you have any comments?
Yeah, that's pretty good, Rich. You did a good job this time. It was good.
This time. He's such an ass.
You didn't leave out anything. We actually even used the phrase I would have said as well. Like I would fade this rally today as well. So from a different perspective here. So today we have equities are rallying and bonds are rallying as well. And that in this environment, one of them is wrong. Right. So when equities are rallying, that implies, hey guys, inflation's going to go up. So you think the Fed are like in this rally today? No way. No. Because all of a sudden the wealth effect is going up, the confidence data is going to go up, and all this stuff. So the Fed is saying, oh boy, we're not the least bit happy with this. And then the other side of it, if bonds are going up in price or the yield is coming down, that's deflationary, right? That shows, hey, we're going into recession. And the Fed, they would somewhat like that, right? Because they want to create that recession. That's what they're trying to do. So now let's switch back to like the main point why everything is rallying today, because the actual numbers month over month, core, year over year, they were all better than estimates. So remember earlier, we were talking about the Canadian jobs data, that it was 10 times above estimates. The American inflation data this morning, like it is within 1 to 2 decimal points of what was expected and what the actual number was. And just to be 2 decimal points away. So for example, the actual year over year number was 7.7 and the estimate was 7.9. And people would say, man, that's splitting hairs. In the investment world, that's a huge beast. Like, that's unbelievable. But in the Canadian market, 10 times, hey, you just, that's fine. But the other thing here that catches our attention right now, again, you're going to see the Fed and Powell, he's going to come out again, guns a-blazing, saying, I don't know how many times we have to tell you you're not listening. We are going to continue to hike rates until we believe that this has been cracked in two, because he keeps going back, referencing the whole Volcker experience we talked about last week. He hiked rates and then he cut them and then he had to, hike them again. So they don't want to repeat that mistake. So here we are today. It's a pretty good risk on day, which is great because, we're all making money, and who doesn't like to make money, right? But I do suspect this is going to roll over pretty soon.
Can I just add one way to prove that why it's a purely based on sort of Fed expectations, and it's something we prove it, who knows, but this is why I'm like quite certain that this is true. It's because earnings just continue to deteriorate. And without those earnings, your P you're right. So you have a price earnings ratio. And so if your E is flat or going down, it's the value that you're willing to pay for that earnings, whether it's forward earnings, it's next year or the year after, whatever, or your trailing earnings. But your P, as part of that PE ratio, is fluctuating wildly, and it continues to be the driver of returns. Because if you look at the earnings, whether it's an earnings model, earnings estimates, and even in the US, you have, the 12-month forward estimates of the S&P 500, for example, they're starting to roll over significantly. So if I had to bet on which one was right, the bond market or the equity market, for me, I'd be betting the bond market's right. But that's just important to remember that. Sorry.
Yeah, Keith, Rich, I was just going to say on your shelter inflation thing, I'm looking at the chart we have in our group chat there. It's definitely, it's sticky, right? I mean, it is what it is. I just find it interesting, like going back to sort of like our conversation earlier, which is talking about inflation, the data, and then looking at sort of like the anecdotes. And like I said, I think we've chatted about this in the show before, but it was a month ago where like you had your 3 largest residential REITs in the US coming out and saying that their rent growth is flat to falling in some of these big cities. So I just think it's going to take a while for that to probably show up in the shelter component of inflation. But to me, I think a lot of that is, again, like in the housing data front, like you're looking at a lot of these like benchmark indices, and then you see, like, you chat with like a developer on the ground, or you chatting with people on the ground, you're getting much different information than what is being shown in these models.
But just to provide more context on why I think you're right. So full stop, you're right. It's a lag. These kind of it's important. Remember, these are sort of lag indicators, and they turn often much slower, than we might be seeing on the ground. But I think I would just remind people, when it comes to the US market, it's a much different housing market than Canada. So even though we've seen some of the housing association data crater, there's 2 things that I think will support house prices in a way that didn't in the last cycle. One is literally supply. So there's something called existing months supply, something Steve is obviously very familiar with. And it's for existing homes, it's very, very low. It's as low. I'm trying to find the chart quickly while I speak. It's as basically as low as it's ever been. I'm looking at it right now. It's at basically 3.1 months. Just to give you an idea, in 2007, it was 10 months of supply, right? And the other thing that's really important I think that will keep sort of a floor on house prices is vacancy rates. And again, these vacancy rates are at 25-year lows for both homeowner vacancy rates and rental. Now, the counter, of course, is you could say, well, there's people who bought second homes, and with mortgage rates rising, they won't be able to sustain it. Again, the US is different than Canada. Those second homes were bought when mortgage rates were 3% for 30 years. So this is like the best trade some of these people have ever made. And as long as they keep being employed, which is, of course, a big if, I just don't see the forced selling that you've seen in other cycles.
Yeah,
So
I think that's just a good point. I think there is actually a quick distinction between the U.S. housing market and the Canadian housing market. So my understanding in the U.S. is when you buy a house there, let's say you bought it, a year ago, you did a 30-year fixed at 3%. It's like the best trade you're ever going to make. When you go to move, let's say you want to upsize to a different house, you actually have to, my understanding is you break that. There is no porting a mortgage. So you break that term, that 3-year, 3% on 30 years, and you now have to go and lock in, say 7% today on 30 years. So most people are like, well, I'm just going to stay put. And so inventory that would normally come up on the market, there's basically just no one wants to basically move. And so those people stay put. Whereas in Canada, right, we port those mortgages. If you locked in a 5-year fixed mortgage last year at 1.5% and you want to move, you just port it to the next house. You typically have 90 to 120 days to make that port. But they're very, very different dynamics.
It's the same in the UK. You can port your mortgage in the UK.
Yeah. So it's interesting. I think that's, and then again, it's obviously, hey, for your longest term here in Canada is basically 5 years, that you're just always susceptible to rates in 5 years, which I think you become much more rate sensitive.
Where the housing market will really affect the US, I think, is, the construction industry is an enormous part of that country's economy. I think it's something like, I can tell you right now, the construction industry is, 7 million people out of 153. So it's, this includes non-residential and residential. So, that's where, things can maybe get a little dicey. But remember, they have a much, much lower household debt to GDP number. And residential CapEx has basically been flat. So it's just that. Go ahead. Sorry.
Well, sorry, I was going to say, but sorry to interrupt you. But by the way, I don't know if you looked at, so the resale data you have there, where the pain you're seeing is in new home inventory. Yeah. I think they're at 9 months of supply right now, which is obscene. Because what happens, right, is unlike a homeowner, developer has to sell that product, and you really don't have much room to cut prices. Everybody thinks developers make boatloads of money. If you've actually sat down and looked at a pro forma in Vancouver or Toronto, the returns are actually not that great. So there's actually not a lot of room to actually reduce the prices. And not only that, but your lender who's giving you the loans for the construction financing, for example, they have a say in that. You can't just start cutting your prices. It's not that simple. So it's actually the spec builders, the new home builders, the construction industry that's going to get creamed here. It's not your average homeowner.
That's my view too. And just by the way, just so you know, you're exactly right. It's for U.S. home supply for new homes is 9.2 months, which is basically as high as it was in 2008-9. And we all know what happened, or most of us know what happened after that.
Hey, Rich, I have a somewhat related question for you. Where you're there in London now, what's the average person talking about economically? Because the prime minister or the Bank of England just said, hey, we're going to have the deepest recession of 40 years. Are people talking about that? Are they experiencing yet?
So you know what the truth is, I don't know, but I have a couple of points that I can share. Number one is consumer confidence measured by GSK, which is a survey company, is basically as low as it was during the pandemic. So the people are not happy, and inflation expectations, and inflation is largely, in my view, the cause for that. Whether it's there's different ways to measure inflation expectations. There's financial situation. Are you going to buy something next month or whatever? One of these, one that I'm looking at right now, the consumer confidence for the next 12 months is the worst it's been in 25 years. Worse than 2009, worse than 2020, and it's just basically terrible. The funny thing is that the job market is actually still hot. So you've got things like vacancy rates relative to the people who are unemployed still really high. You've got like, and then you have like wage growth is like actually sort of okay.
Maybe
is that not a lagging indicator too, though?
Yeah, sure. But I was going to say, and then the anecdotal evidence is you've walked down my high street. There's like every single, like not every single, but there's at least, honest to God, like 10 different shops that say like help wanted, please apply within, blah, blah, blah. And so don't get me wrong. I think that the UK is in deep trouble. I don't think the Bank of England says something like that without meaning it. I don't think they would just, I think that they're quite calculated in their messaging, and I think they're trying to provide people clear, sage advice, which is they're terrified about what's going to happen to this country. But at the same time, London is its own beast, right? And it's like a weird. So that's why I'm confused. Frankly, I've had these like super negative indicators, which of course I'm not ignoring. But then there's like a couple of these positive ones that are screw it all up.
Hey Steve, imagine that. Rich is confused.
Oh, you're so mean. I mean, house prices are definitely falling or starting to roll over.
Just one thing, maybe for next week, you can break down how these confidence models are actually calculated. So just so people have a better appreciation. Because, for example, the stock market. No, it's actually more interesting than the diffusion index. But maybe next week we can break down how these confidence surveys are actually broken down. So, for example, the stock market does have an impact on what the number is. So if markets are doing well, people feel happier and so forth. There's something for next week. But I think, Steve, you had one more thing, or do we have to wrap it up?
Yeah, we're going to wrap it up, but I was just going to quickly comment. I've brought him up before, but he's a great follow on Twitter, Craig Fuller. So he's the freight guy. So he just keeps commenting on sort of freight shipment costs and what the volumes at these shipping facilities and whatnot, because that's really like a great indicator of demand for goods. And so he's saying the deterioration in freight markets is now triggering large layoffs. C.H. Robinson is laying off 1,200 folks today, the largest layoff I can recall at a freight broker ever. That's from Craig Fuller. And then, of course, if you saw in the news as well, FedEx has also been cutting flights and parking planes to curb costs in the face of weak demand. So, I mean, I think that's pretty telling, again, like whether that shows up in the actual data or not, but to see some of these large companies parking planes, shipping rates moving down, I think is an indicator that demand is pretty soft heading into what apparently, I mean, well, not apparently, it's pretty obvious, the busier time of the year typically for goods, right? You've got Black Friday coming up, you've got Christmas, Boxing Day. This is prime time for a lot of retailers, and I think it's going to be interesting. So that's kind of where we'll leave it for now. As always, we appreciate your guys' support. All we ask is that you leave us a 5-star review, give us some comments, Spotify, Apple, as we continue to grow the podcast, the Loonie Hour community, and please share this with at least one friend or family member, and we'll see you next week.